What's going on, my fellow wealth creators? Matty Ice here. Welcome to another training. We are going to have an absolute blast in this video. I cannot wait to read the comments on this one. Right? We're definitely shaking things up. It's going to be a pretty controversial video, I think. But we're really shifting the conversation of IUL versus whole life. And I think really putting that conversation and debate to bed forever, like once and for all. And you stick with me to the end. I think you're going to agree that IUL is a completely useless product, in my opinion. And I can't think of any reason why someone would purchase an IUL when the alternative that I'm about to show you is available to us. It just does not make sense. So here's the sales pitch for IUL. Really is the upside potential and downside protection in the market, right? The problem is all the things that can go wrong with an IUL. And it's not even really the IUL itself, the product itself, that I have an issue with. It's how it's presented, illustrated, and sold to people. Like, I don't think people actually know what they're putting their money into with these things. They look at this Fantasyland illustration showing you 7% uninterrupted compound growth every single year. Like, that's really going to happen. Tax-free, you get all this tax-free retirement income, and like, it looks really good on paper, but do you actually know what you're putting your money into? And that's what I really have an issue with. But besides all of that, with the typical conversation and debate of IUL versus whole life, like, everybody has their defenses for each one, their reasons for each one. None of it actually matters because this alternative is available. You can get upside potential, downside protection in a whole life product, guys. Did you know that existed? I didn't know it existed until a couple of months ago. And I think that's why it's not talked about a lot, and why there's always the debate about like surrounding the mechanics of and the strategy of each of these products, like how it's used and whatnot. But it doesn't really matter if there is an alternative to get the same benefit of upside potential, downside protection with the guarantees of whole life. Like, why on earth would I take all the risk, inject all the uncertainty, all the things that can go wrong with IUL to get that upside potential, downside protection, when I can get the same thing with the guarantees of whole life? It just doesn't make sense to me, right? So what I want to do is I want to break down some specific bullet points here on how this product works, and to finish my thought on why I think it's not really talked about a lot, is that this isn't a very common product. This isn't usually how whole life products work. Usually, the way the cash value grows in whole life is the guaranteed growth rate and the dividends that get paid out. With IUL, it's based on the performance of whatever index you choose, price of call options, etc. Right, but it's not a very common product. In fact, as of right now, I only know of 2 companies that offer this on their whole life products. So it's not very common. That's why I think it's not talked about a lot. But I wanted to share this with you guys because as soon as I learned this existed, the whole IUL versus whole life conversation ended for me. Like, there's just no point to IUL. So let's get into it. And I'll mention too, I'm actually setting up my second infinite banking policy with this particular company and whole life product to take advantage of the indexing strategy. So here's what's really cool, guys. I'm going to start off with this. As part of the sales pitch of IUL, that benefit of upside potential, downside protection, you get that zero floor, right? Even though you can absolutely still lose money in an IUL, just because you don't lose it in the stock market and you lose it to cost of insurance and other fees, it doesn't mean you didn't lose money. Like, who cares how we lost money? We lost money, right? So don't think that you can never lose money in an IUL. It's absolutely ridiculous. But that zero floor, what if your floor was 3.25% instead of 0? Would you take that? I know I would. And the reason that this exists is because it's based on the guarantees of a whole life product, not the annual renewable term of IUL. So whole life products can provide these types of guarantees because it's in the contract. It's contractually guaranteed to grow by a specific rate. So our floor is actually whatever that guaranteed rate is. And with this particular company, that's 3.25%, contractually guaranteed. It still grows tax-free. You have access to it tax-free, just like you would in an IUL, assuming you don't mech the policy, modified endowment contract, right? It's set up correctly, etc. So your floor is actually 3.25% instead of 0. So right off the bat, just with that, to me, this is way better than IUL. But let's talk about the crediting and how you like, where does the crediting come from with that upside potential in the market? It's actually a lot simpler than an IUL. IULs are far more complicated than people make them out to be. But here's how it works. And this is actually how it works with IUL also. Is they take your dividend, whatever your dividend would have been for that year, instead of crediting that to your cash value, they take that and they go purchase call options on a specific index. With this company, with this indexing strategy, there's only one index, guys. It's the S&P 500. So you don't have to sift through or sort through, however many indexes, volatility indexes. Do I do the NASDAQ, the Dow, the S&P, blah, blah, blah. Like none of that. It's just the S&P. That's it. Keeping it just super simple. So they buy call options on the S&P, and this is why this is where that downside protection comes from, guys. I think this is really important for those of you that aren't familiar with how that indexing strategy works in an IUL, and then in this case, this whole life product as well. Is like, where does that downside protection come from? It's because they're purchasing call options. You're not actually invested in the market. So if the market goes down, basically what happens is the call options just expire worthless. So you only, in this case, you only lose your dividend. That's it. But you still get that floor of 3.25% with this whole life product. But that's where the downside protection comes from. I think it's really important to understand that. Again, I'm a big believer in understanding how these things work. If you're going to be putting a decent amount of money into it and making all these financial plans around, retirement income and stuff like that, whatever it is you're using it for, you want to know how these things work. All right, let's continue. So here's how the crediting works. If the S&P goes up 5%, then you're going to receive whatever your dividend would have been. That's it. If the S&P goes up 10% or more, they double your dividend. That's it. Doesn't matter how much the S&P goes up. It could go up 10%, 11%. It can go up 40%, whatever. They just double your dividend. That's how that works. So much simpler. And there's like, if it goes up 7%, there's multipliers, right? So you might get like 1.25% or 1.25 times your dividend, whatever. All right. But it's a very, very simple crediting strategy. So if I were to get a $5,000 dividend and I implemented this indexing strategy, this indexing option, then and the market does at least 10%, I get a $10,000 dividend instead of the $5,000. That's it. So I get upside potential, downside protection with a floor of 3.25%. Now, here's the other cool thing, guys, is you don't even have to use this indexing option if you don't want to. This is a rider that is attached to the whole life policy at no cost. It's free. They don't charge you to have access to this indexing option. So you could turn it on and off however you want. So if you're someone that follows the market and you think, yeah, I think the market's going to go down the next couple of years, I'm going to turn this off and I just want to receive my dividends. That's it. I don't want to participate in the market or the indexing strategy. Just credit me my dividend. You can do that. And then when you think the market's going to go up, turn the indexing strategy back on. They're going to take whatever dividend that they would have paid you, buy the call options on the S&P, and we see what happens, right? But we still have that 3.25% floor, okay? Here's the other cool thing. You could do 50% of your dividend. You get to control how much of your dividend is allocated to this indexing strategy every single year. So if you want to be a little bit more conservative and do 50%, you can, basically what that means is when using the $5,000 dividend example, right? If I were to get a $5,000 dividend and allocate 50% of that to the indexing strategy, they would credit $2,500 of my dividend to my cash value immediately. And then they take the other $2,500, put that towards the call options in the index strategy. And then if the market goes up at least 10%, I just doubled that $2,500. So I got a total of a $7,500 dividend that year instead of a $5,000. That's just one example, one hypothetical scenario. But I'm saying there's a lot of flexibility with this where you can control how much of your dividend gets allocated to this strategy every single year. It's totally up to you. And there's no cost to do that. It's awesome, guys. And I love the simplicity of it. We don't have to worry about annual point to point or 2-year point to point multipliers, which index to do. There's no cap rates we have to worry about. There's no participation rates that fluctuate. Here's the big thing too, guys. There's no, the risk of rising cost of insurance. It's gone. This is a whole life product. Your costs, your premiums, whatever you're paying, it's permanent within the policy. Okay. There's no rising cost of insurance. Your cost of insurance is already baked into the policy. That doesn't change. With IUL, guys, every single year, your cost of insurance goes up. Now, your net amount at risk might not go up that particular year, and that's fine. And that's usually the argument that IUL agents make is it's not about cost of insurance, it's about net amount at risk. Well, when your net amount at risk starts to take off in the later years, when you're in retirement, you're taking a bunch of income from this, and you have a couple of 0 years, you're not getting the crediting like the illustration showed you getting every single year with that positive arbitrage. What happens to the policy? Where does the cost of insurance come from? Where does you got that loan balance stacking up too? All that takes away from the cash value, which then spikes your net amount at risk, on and on and on, right? So I'm not saying that will always happen in an IUL policy, but that is a risk you need to be aware of, okay? If you're considering IUL, but then does that even matter now? Because if you can get upside potential, downside protection with the whole life product, why on earth would you do an IUL? I don't know why. There's no fee. Like I said, there's no fees for this rider. You can turn it on and off whenever you want. There's also an overloan protection rider included at no cost as well to make sure that you don't over leverage the policy. The policy won't lapse because of you took too much out in policy loans. And they do have that with IUL. The problem is, when you get older, let's say you're 75, 80 years old, and you actually have to turn that rider on, the overloan protection rider, which means you've basically tapped out all of your cash value. What happens the next time you have a 0 year and you're 80 years old and your cost of insurance is ridiculous at that point? Where's that going to come from? What protection rider is going to protect you from the ever increasing cost of insurance every single year in an IUL? And if you can't cover that policy lapses, you get a massive tax bill. You lose everything you put into the policy. It's just a disaster, guys. And again, I'm not saying that's always going to happen with an IUL, but if there's that potential and we have an alternative over here that's not even a possibility of happening, why would we do an IUL, guys? I don't understand. Let's go ahead and finish up here. Where are we at? Oops. Go back to StreamYard. So yeah, I'll wrap up with that, guys. To me, this is just like a no-brainer. This just ends the conversation of IUL versus whole life. There's just no comparison here. This is such a powerful product, in my opinion, when it comes to if there's anybody that wants that or is intrigued and wants to implement the indexing strategy to get the upside potential in the market, like you still want to be involved in that. Then like why not get the guarantees of whole life, and like why even mess with the IULs? Why roll the dice with your future retirement or like whatever it is that you're setting these up for? Why take the chance when you get the guarantees of whole life? So I would love to get your feedback, guys. I cannot, like I said, I can't wait to read the comments here. So please put your feedback in the comment section below, whatever it is. If you agree, great. If not, why don't you agree? I want to know specifically, what is it that is, what did I say that was inaccurate? What did I say that doesn't make sense specifically? I would love to hear this, because to me, this is, this ends the IUL whole life conversation, but maybe I'm missing something, and I would love to know what that is. So drop down in the comments. Either way, I hope this was helpful, guys. If you want to have a conversation about this, join my infinite banking community. There's multiple ways to connect with myself and my team, and we can have a conversation, see if this is a good fit for you. Just talk about infinite banking in general, if that's a good strategy for you, whatever it is. All right. So either way, I hope you guys are doing awesome. I hope you're crushing it, and I will talk to you in the next one. To your success, Matty Ice is out. Peace.